Right, so continuing on learning objective 2, these are the exercises that go with it. Just be talking a little bit about the thought process behind each one. So this one is the Richardson Company enters into a contract to deliver mowers to a landscape company. The contract requires the landscape company to pay the contract price of $900 before May 15th. So on the, okay, so anyway, on the 15th, the landscape company pays, and on the 17th, the mowers are delivered. So we're supposed to prepare the various journal entries. And so the point that this problem is making is that there is no journal entry on the 1st because nothing has happened yet. Just the fact of entering into a contract, or the act of entering into a contract, does not generate the journal entry because nobody has done anything yet. No performance obligation has been satisfied. So the first journal entry happens when the landscape company actually sends in the check for the $900. And at that point, that's cash and unearned sales revenue because they don't have the mowers yet. So now on the 31st, is that the right date? Yeah, on the 31st, the mowers are delivered, then the revenue can actually be booked by Richardson Company, and you do the cost of goods sold and inventory. So main lesson from this problem is don't do the journal entry on the signing of the contract. It can only happen when either the customer gets the goods and they have there's an account receivable generated, or there's been cash payment made, or maybe there's been a cash payment made and the goods have not been delivered yet. But something has to have happened for the revenue to be booked, or for the journal entries to start. Okay, so let's look at 4. And these problems are all really kind of complicated, but we'll get through them. So Jupiter Company sells goods to Dantone by accepting a note receivable on January 2nd. So right there, you know that you're going to have the sales price, you're going to have amount of cash that's eventually going to be remitted for the sales price plus interest. So the sales price is $610, cost of goods sold $500, the terms are net $30. If they pay within 5 days, they can get a cash discount. Past history indicates that the cash discount will be taken. And on the 28th, Dantone makes full payment. Okay, so that's not within the discount period. But anyway, it says prepare the journal entries to record the sale, related cost of goods sold, assuming that they're using the net method. So this would be a good time to review the net method versus the gross method. Okay. So in this case, the note receivable is $600,000. You get the sales revenue, and you've got the cost of goods sold and inventory. And this is a short enough note so that they're not doing the interest as a separate amount, but it's probably the size of the purchase that generated, they'd rather have a note than just a simple open account receivable. Okay, so we get note receivable, sales revenue, the cost of goods sold, and then because they did not pay within the discount period, you're booking the cash comes in at $610 because they have got to pay they didn't pay within the discount period, reduce the note receivable, and you've got a sales discount that was forfeited. Okay. Part B of this says prepare the journal entries if it were the gross method, and in that case you would do the note receivable at $610, which would, and that would be including the possible discount. So $610, you book the sales revenue at $610, and then the cost of goods sold inventory, and then when they pay, they've obviously just paid the full amount. So most companies are going to use the gross method, but accountants like the net method better, because the gross method assumes that no one will take the discount when in fact most people do. So we can go over more on the gross and net method if we need to. Okay, so that would be 4. 5, this is coming up with the transaction price, and basically this is another one of the bonus ones where you're coming up with the expected value of the bonus under 2 different situations. In A, they're simply asking, to compute the transaction price. And so if we complete it on time, we get so much, and there's a 55% of that. And if we're 1 week late, it's a 30% chance, and so forth. And so this would be the transaction price under those circumstances. Assume that after reviewing the work schedule, and this is part B, they now believe the probability of completing the project on time is 90%, otherwise it'll be 1 week late. And so you're just recomputing the probabilities again, and so you come up with the present value of 239. Okay. Sometimes you don't want to make these problems more complicated than they are. Okay, so for 6, again, we're trying to figure out the transaction price here. At this company, the problem's a lot longer than the answer. They sell commercial properties. They sold land for $3 million to Blackhawk. They're going to build a new shopping mall. In addition to the $3 million, Blackhawk agrees to pay Real Estate Inc. 1% of the retail sales of the mall for 10 years. So Blackhawk, the buyer, estimates that the typical retail sales will be about $1 million a year, but, and this is given the substantial increase in online sales, Real Estate Inc. would rather have had a higher price for the land instead of that royalty arrangement, and suggested a higher price, but Blackhawk didn't agree to those terms. So what is the transaction price for the land and the related royalty payments that Real Estate should receive, Real Estate Inc. should receive? Well, they're going to get the $3 million, and once that's certain, then they would call that their transaction price. But the royalty payments would have to be recognized each year as they occur in this situation, just because of the uncertainty. Maybe everyone's buying on Amazon and nobody's going to the mall. So that's the thought process that goes in here. So you can see there's a lot of judgment calls with this new revenue recognition. Okay, and then the last one we look at is 18.7. Let's take a look at this. Biotech company licensing agreement with the pharmaceutical company for a drug. Blair gets payment of $10 million if the drug gets regulatory approval. They think it will, 90% that it will, 10% that it won't. And so we're supposed to determine the transaction price under A. And if it's a 90% chance, well, yeah, we could probably, we'll call that the transaction price. Okay, so, and it says, assuming that the approval was granted on the 20th, and that they received payment, just make the journal entries. And so this is what you would do for those, fairly straightforward. Okay, so that works through some of the problems related to learning objective, or some of the exercises related to learning objective 2.